Detailed requirements for forming a tax group under UAE Corporate Tax Law. Introduction to tax group formation and its benefits. The concept of a tax group under the UAE Corporate Tax Law is designed to allow businesses under common ownership to be treated as a single taxable person for the purpose of calculating and paying taxes. By grouping companies together for tax purposes, businesses can simplify their tax compliance requirements, reduce administrative costs, and enhance operational flexibility. Key advantages of forming a tax group include: 1. Consolidation of tax liabilities. Tax groups can consolidate their tax liabilities, which means that they only need to file one set of tax returns and account for taxes at the group level. This streamlines the tax filing process and reduces the burden of compliance for individual companies. 2. Elimination of intragroup transactions. Transactions that occur between companies within the tax group are not subject to tax, which prevents double taxation within the group. This also reduces the complexity of tracking and reporting intercompany transactions for tax purposes. 3. Utilization of tax losses. A key benefit of forming a tax group is the ability to offset tax losses within the group. If one member of the group incurs a loss, this can potentially be used to reduce the taxable income of other members, optimizing the overall tax position of the group. 4. Simplified compliance. Instead of each individual company being responsible for its own tax filings, the entire tax group will be treated as a single taxable entity. This simplifies the reporting process and makes it easier to ensure that all members are complying with the tax obligations in a consistent manner. Businesses that operate across multiple entities under common ownership will benefit from the ability to consolidate their financial and tax reporting. However, forming a tax group is subject to fulfilling specific criteria outlined by the UAE Federal Tax Authority, FTA. The parent company plays a crucial role in this process, as it must submit an application on behalf of the group, ensuring that all members meet the necessary requirements. Steps and requirements for forming a tax group. In order to form a tax group under UAE Corporate Tax Law, the parent company must initiate the application process, and all subsidiaries wishing to join the group must also be involved in the application. Several conditions must be met for the group to be eligible for tax treatment as a single taxable entity. 1. Application process. The application to form a tax group must be submitted by the parent company. This company acts as the representative for the entire group and must ensure that all necessary documentation and information are provided to the Federal Tax Authority, FTA. Each of the subsidiaries that wishes to be part of the tax group must also submit an individual application to the FTA. These applications will be reviewed by the FTA, and the group's eligibility will be determined based on the criteria outlined below. 2. Residency and juridical person status. Both the parent company and all subsidiaries wishing to be included in the tax group must be resident juridical persons under the corporate tax law. A juridical person is an entity that has legal rights and responsibilities, similar to an individual, and can include limited liability companies, LLCs, public joint stock companies, PJSCs, or any other legal entity recognized under UAE law. The residency requirement means that both the parent company and its subsidiaries must be established in the UAE and subject to UAE tax laws. Additionally, they must be resident under the terms of any applicable double taxation agreements, DTA, which help ensure that entities are not taxed by both the UAE and another country on the same income. 3. Financial year alignment. One of the key requirements for forming a tax group is that all companies in the group must have the same financial year. This ensures that the group's financial results are consistent and aligned, simplifying the tax filing process and preventing discrepancies in tax reporting. The financial year of the parent company and all subsidiaries must start and end on the same dates, and they must follow the same accounting period for tax purposes. 4. Uniform accounting standards. All members of the tax group, including the parent company and its subsidiaries, must prepare their financial statements using the same accounting standards. This is important for ensuring that the group's financial results are consistently reported, and the calculations for tax purposes are based on the same set of rules. Consistency in accounting standards ensures that financial results can be consolidated accurately across all entities within the group. 5. Exempt persons and qualifying free zone persons. Exempt persons and qualifying free zone persons are excluded from forming a tax group. An exempt person refers to an entity that is exempt from corporate tax under UAE law, while a qualifying free zone person refers to a business entity that operates in a UAE free zone and meets specific criteria for exemption from taxes. Because these entities are subject to different tax treatments, they cannot be part of a tax group, which aims to consolidate tax filings for companies that are fully subject to corporate tax. Ownership criteria for tax group eligibility. The ownership structure of the companies involved in the tax group is one of the most critical factors in determining eligibility. The parent company must have a substantial level of ownership in each subsidiary to ensure that it has control over the operations of those companies. Specifically, the parent company must meet the following ownership conditions. 1. Ownership of share capital. The parent company must directly or indirectly own at least 95% of the share capital of each subsidiary that is seeking to be part of the tax group. This level of ownership ensures that the parent company has control over the subsidiary and can fully consolidate its financial results for tax purposes. Ownership of 95% indicates a high degree of control and alignment between the parent company and its subsidiaries. 2. Control of voting rights. The parent company must hold at least 95% of the voting rights in the subsidiary. This requirement ensures that the parent company can make critical decisions for the subsidiary, including decisions related to financial matters, tax filings, and corporate governance. The voting rights must align with the parent company's ownership of share capital to maintain effective control over the group. 3. Entitlement to profits and assets. The parent company must be entitled to at least 95% of the subsidiary's profits and net assets. This ensures that the parent company has a significant financial interest in the subsidiary's operations and performance. The 95% entitlement criterion ensures that the parent company has a majority stake in the subsidiary's profits and assets, which is crucial for tax consolidation purposes. Residency and tax confirmation for parent companies and subsidiaries. In addition to the ownership requirements, it is also necessary for both the parent company and its subsidiaries to be considered tax residents in the UAE and not in any other jurisdiction. This is an important consideration for determining the tax treatment of the group. If any member of the tax group is also considered a tax resident in another country under a relevant double taxation agreement, DTA, additional documentation may be required to confirm that the entity is not considered a tax resident in that jurisdiction. This documentation could include a tax residency certificate or a confirmation from the tax authority in the other jurisdiction stating that the entity is not subject to tax there. For more details, contact us.